Okay, this is Mike Durr, the Kingwood Mortgage Guy, and this is one of, I think, the better presentations that I've put together in a while, and it's only because I've been getting a lot of borrowers that have less than perfect credit, and it's something I kind of specialize in, and I just thought that it would be a good time to give people some hope and some clarity as to what is the process from going from the 500 FICO score range up to 700. It's a process. A lot of times there are details that we're going to try not to get into the weeds on tonight, but the premise of this is just to kind of give you a rough idea, a general idea on the things that you can do with your credit. And I encourage you, if you have a specific scenario, that you contact me, because the truth is I help a lot of people in this arena, and I can guide you. I don't charge anything. My job is to get you in a position so that you can qualify for a home mortgage in today's marketplace. And I did a video this week that talked about how most people out there that have had any kind of credit trauma at all, they shy away from talking to people like me because they're afraid of rejection. They are fearful that they don't have 20% to put down. And I tell you, it's just so not true. And I see it all the time. I mean, I tell people that 50% of the people that are hesitant to contact me because of credit or whatever, the truth is that they qualify that day. It's not like we have to do anything. It's just a matter of some very subtle, if anything. And perfect example is a young couple that contacted me just this last week. Once we went through the process of evaluating their income, their credit, their debt, we learned that if they had $300 that they could put in the direction of a particular credit card, that their scores would raise to a level that would qualify them for an FHA loan. Minimum down payment, they had the down payment already saved, and it was one of those success stories, and it happened really fast. So that can happen with you. And as we get ready to get started, I've got just a couple minutes here, and we'll get started with this presentation. I expect that the presentation is going to last 25 minutes, 20 minutes, something like that. And again, the premise not being going into the weeds too much, but to if you would like to contact me and talk to me about looking at your credit, doing an evaluation, seeing what the options are, what kind of journey, what kind of plan you want to go on, if you're willing to do the things that I tell you to do, we'll have a successful culmination, and we'll be able to get you in a house and out of renting. And that can be a good thing. Anyway, in the meantime, the weather has been spectacular, and I want to do this as quick as possible. You probably want to get outside too. So again, we are going to start in a couple seconds, and then we'll go from there. Okay, I've got 6 o'clock straight up, and I am so glad that you're here with me today. We're talking about one of the subjects that I talk about a lot. This one I describe it as how to go from 500 to 700 credit scores, prepare for a journey. For some people it's a journey, for some people it's not much of a journey. And the truth is, you don't have to go from 500 to 700 to qualify for a mortgage. But a lot of people, once they see how this works, they're going to vault themselves from maybe 550 to 600, where we can get you a loan. And then from 600, it's just a matter of understanding how the scoring mechanism works and what you have to do. And once they learn that, it's amazing what can be attained. And there's a lot of proof behind that. It's just knowing what you need to do. So with no more ado and chatting, we are going to get started right now. The first thing I always start these off is with moving the next slide. There we go. I am the Kingwood Mortgage Guy. My name is Mike Durr. I've been in the Kingwood area for the last 20 25, 26, 27 years, and love Kingwood, love the Houston metropolitan area. Just because I'm licensed and live in Kingwood in the Houston area, I do loans all over the state of Texas. I'm licensed by the NMLS. My NMLS number is 318989. That's where people, if you ever got mad at me or something, you could go and complain. Fortunately, at this point, after 21 years in the industry, I haven't had any complaints. I'm pleased about that. That's not to say that there won't be one that comes on today, and maybe about this webinar or whatever. But I do have positive reviews right now on Google. I have 44 positive reviews that are 5-star reviews. Love you for you to check that out. The site that this webinar goes on, this is my version of a weekly webinar, and this one's it goes to homebuyerwebby.com, and you can access that from homebuyerwebby.com, or you can go to kingwoodmortgageguys.com and click on the FAQ, and you'll see, it'll take you to the Homebuyer Webby site. You'll see all the previous webinars that we've done. I like to keep them as short as I can, and so with that, I'm going to shut up, or no, I'm not going to shut up. I'm going to move on to the next slide. But notice my phone number. You'll see my phone number consistently on that. Love to hear from you. Again, I don't charge for any credit analysis or anything like that, so I'd love to hear from you. So here's what we're going to cover today, and the reason I give you what we're going to cover today is because I don't want you to be confused and wait around for something that you're not going to get. If this is not what you're looking for tonight, this is not a good place to be. You can be going outside, you could be watching your favorite TV show or watching the news or whatever you want to do, taking your honey out to dinner. But here's what we're going to cover today is how you got where you are. The people I'm guessing that are going to be watching this are going to be people that have had some kind of credit issue. We're going to talk about one of two paths, and if you have recent lates, maybe you're not quite ready to do this. I'm not telling you you're not ready to watch this webinar, but you might not be ready for the credit restoration or the credit improvement part. The other part is you've had no late pay since the last year. If that's the case and you have no late payments in the last year, then you're probably ready, and this would be a good thing for you. We're going to talk about one of the methods, and I think it's one of the key methods that you can use to start showing positive credit on your credit report. We're going to talk about dealing with collections, if you've got collection accounts, dealing with charge-offs, dealing with judgments, and then we're going to talk about dealing with disputes, and all those are things. Now, the one thing I'm leaving out is I'm not talking about bankruptcy tonight because I did a separate thing on bankruptcy. I'm also not talking about foreclosure. Again, those are things that would go into this, but I'm afraid that it would last too long. So we're going to cover what we're going to cover, and we'll talk about those other things at a different time. Obviously, you see my phone number down there. I want you to call me. I do want you to call me. Not right now, but when you are watching this. Okay, so how did you get here? And when I say here, I mean that you might be somebody that has credit that's below 600. You might be in the 500s. You might be in the 400s. It doesn't matter. Most people who have low credit scores had some kind of financial trauma. Now, I'll be the first to tell you that good people have bad luck. I mean, sometimes just because you have a low credit score does not mean you're a bad person. It just means that you probably had some kind of trauma that you could not avoid for whatever reason. They usually rear their ugly head in the form of some kind of health problem, some kind of accident or surgery or something to that effect, which causes a skip or a stoppage of your income. The same thing can happen with a divorce. Divorces are very tough financial things that happen, and it could happen to both people on the divorce. It could happen to just one or the other, but it's a real shocker, a real trauma to one's lifestyle and their financial life, and it causes a lot of problems with their credit. And it's not unusual for people to come out of a divorce with rotten credit. And then the next one, this is one that we've seen a lot over the last couple of years, is a job loss, whether it was a termination or a layoff or whatever it was. The industry, particularly in the Houston metropolitan area, there have been a lot of people, not now so much, but in the last 2 years, that were laid off for whatever reason because the oil industry has been not as robust as it had the years before that. And of course, the price of oil is down. When the price of oil is down, oil people don't hire as many people. So could be any, and that's not a complete list, but those are the three biggies. And so I understand that. And the key thing is I understand that people that have rough credit are not bad people. There are people just like everybody else that have had something rough happen to them. And, you know, you live long enough, guess what? Something rough is going to happen to you. It just depends on how you handle it. And what I'm trying to do with this presentation is give you the tools that you need so that you can get past this and you can put this in your rear view mirror. I think that would be a good thing. So you're in one of these three modes, I'm guessing. I'm making some assumptions here, but you are currently late right now on some existing credit bills. And if that's you right now, then you're struggling having enough income to handle the bills that you have or that you're obligated to. And I'm going to tell you that if that is the case, this is not the time for credit restoration. There's some other things, and that's a whole different discussion. But if you are still struggling with your income compared to your outgo, it's not time to do this stuff yet. Now, it's not going to be bad information for you. I'm just telling you, you may want to wait. Here's the next thing. Or you have recently let bills go to collection and you're operating on cash. Now, that's usually one of the next steps that happens when you have this trauma, this lack of income, and all of a sudden you still have bills coming in. Sometimes you have to make some choices. If you have choices about whether you're going to put a roof over your head or whether you're going to eat your next meal or whether you're going to keep the lights on or particularly the air conditioning on, and this particular as we get into the summertime, those are decisions that you have to make. And there might be some people that don't get paid in a particular month. And this is hard, it's gut-wrenching, it can be traumatizing, but you have to make a real decision on what's important. And right now, surviving this period is what's important. The third category is that you possibly have gone through the rough income problems, you've back on top of things where you're making the income that you either made before or that you're making more income than you had previously. Maybe you let some of the bills go to collection, but you're operating on cash now. You kind of quit using credit because nobody was allowing you. Nobody was offering you credit. And so you've been operating on cash. And there's a lot of people that do that, particularly when you have some credit trauma. You just fall back into this mode. Well, guess what? You don't have access to credit. You operate on cash. Checks, your own bills, could be a debit card. That's the way you're operating. And you may have even started to the point of saving some money, anticipating that you're rallying. And then you're also tired of paying rent. Now, what happens is a lot of times when you walk away from credit, the only thing that's left on the credit is the stuff that happened, the collections and things that you didn't pay. And unless you do something about that, your credit score stays low. There's no new input except for the old negative reporting stuff that it has. And this is something a lot of people don't understand, is the credit score is really not going to get better until you do something positive to make the credit get better. And that's what we're going to talk about later. Okay, so hang in there with us. There's not too much to do, really, until you stabilize. So until you get your income stable and consistent, you shouldn't really worry about clearing up your credit yet. It's just not time yet. If you started working on some of these things but you didn't have a consistent income, then you're going to fail again. So I encourage you to work on focusing on getting that income up to a consistent level so that you understand and you can handle what's your exact expenses are that are around you. And obviously making a budget, and I've been known to give Dave Ramsey books away. If you don't know who Dave Ramsey is, I'd love to tell you about him. He's all about making a budget, living by it, very life-changing, helpful information. And I'll just say it like that. And don't call me if you just want a book, but if you come in and we talk and I think that you're sincere and stuff like that, I have a pile of Dave Ramsey books that I like to give away because I think what he's got is some of the best information you can get as far as learning how to handle finances in your life. But I wax on. I'm going to move on here. All right, so once you stabilize your income, this is what I'm going to suggest you do. Get what's called a secure card, maybe even 2 of them, and I'm going to explain what that is in a minute. What we're going to do is we're going to use it sparingly, spending no more on this secure card. Secure card's a credit card, spending no more on it than $50 a month. Okay, make it very clear. We're not spending this. We're not going to run the limit up to the max. We're going to spend no more than $50 a month. When the bill comes in, we're going to pay it off immediately. Okay, so as soon as you get that bill, you're going to pay back. And I'm going to tell you right now, this is the part that mixes a lot of people up, and I'm going to stick by this. I don't want you to pay the bill completely off. In other words, I don't want you to pay it to zero. I want you to leave $5 or $10 on the bill each month. Now, if it says minimum payment and the minimum payment brings it to zero, then pay the minimum payment, okay? But if you charge $50 and you get the bill and it says your minimum payment's $15, I don't care if you pay the $15, I don't care if you pay the $40 and leave $10 on there, or pay $45 and leave $5 on there. Doesn't matter to me. I do want you to leave some balance on there if it allows you to do that. If it says minimum payment's $50, pay the $50. Okay, it's not the end of the world, but what we're trying to do is we're trying to avoid, because here's what we've learned that the credit algorithm, the credit scoring algorithm does. If you have a zero balance on your credit card, and it's that time when the creditor reports to the credit bureau, you'll get 0 points. Generally, the way that we get points is we give the credit scoring algorithm what it's looking for to give you points. And what it happens is when you have we're going to use $500 as our limit on this credit card. So you got a $500 limit. Well, what the algorithm likes and rewards you points is when you have a $50 balance. So you're only using 10% of the capacity that you have. And that's when you get the maximum number of points. That's what we know. We've seen it over and over again. Okay, is it exact? No, it could be that it could be $40, it could be $60. You're going to get maximum points. What happens though is as your balance goes up to 50%, so in this case, $500 limit, $250 balance, you get 0 points. That's par. As you go above 250, they take points away. As you go below 250, they start giving you points, and they give you the maximum number of points. What we're telling you is 10% of the limit, or $50. So what I want you to do is I don't want you to be zero and get nothing. I'd rather you be at $5 or $10, and guess what? You're going to pay interest on $5 or $10. So let's just say, worst case, you leave a balance of $10 and you're paying 18%. So that might be 18 cents in interest. That calculation may not be exact, but it's not going to be much. And we're only using this as a tool to build our credit scores up. Okay? So let me move on. And I know I'm going to get some questions on that, but I want to go here. What is a secure card? You may have never heard of a secure card. Some banks, not all of them, mostly the smaller banks, and in some cases pretty much all the credit unions, will give people who have poor credit a secured credit card. But they don't give them to you. What you do is you have to go in and apply for them, but the way you get one is the credit card is secured by money that you have taken and deposited into this savings account at the bank or credit union that you're applying for. Okay, so you're taking your money, you're going to deposit it into the bank, into a savings account, and the bank is going to use your money to secure the credit that they're going to extend you. They're basically charging you an interest rate, credit card interest rates, reasonably high interest rates for the use of your own money. And it's okay. And here's why it's okay. Because it's a tool that you're going to use to get your credit scores up. Okay? So the banks aren't bad. They're just taking advantage, or they're being an ally with you in this particular case. Now there's one catch. And the catch is that the credit union or bank, you have to ask them, do they report to all 3 credit bureaus? If they don't report to all 3 credit bureaus, this is a waste of time. You're not going to get any benefit from that. So that's a critical part of this. So what I did is I used here a Barclay card, and I want to just kind of show you here. The minimum payment was $20. in this particular case, the previous balance was $17.62. Evidently, the person paid the $20 and had a $17.42 statement balance. Now, here it tells you the credit available and the cash credit line. So, and then the credit here, $4,500. If you see that, let me, well, I'll try to increase that. But it says the credit line is $4,500 and the balance is $17.42. If I do the math right, that's probably about 35% of what's used. So this would be a positive situation. But what would be the ideal situation for this particular person? If they had a $450 balance. 450 is 10% of the 4,500. So I just wanted to point that out. All right, so now we're going to talk about, in each case, we're going to talk about collections, we're going to talk about charge-offs, we're going to talk about, what else, judgments, and we're going to talk about disputes. So what do you do with collections? So you've got collections on your account right now. We're talking about repairing or getting you back up to snuff. And there's a couple things. It depends on the age and the amount of the collection as to what we do with it. Here's why. If the collection is over 2 years or older, I tell you to do nothing. Now, I'm going to back off that for a minute, and I want to share with this. If you feel that you owe this money, I encourage you to work to pay that money off. It's going to help your credit-wise, but it's also a sincere statement to honor the obligations that you incur. When people take you to collections, because you owed them the money. Now, for credit scoring, though, that particular collection account has no effect on your credit score after 2 years. Huh? Yeah, it's real. And so what I'm telling you, if we're just doing a credit scoring scenario, then I don't want you to call them. I don't want you to talk to them. I don't want you to do anything, because at this point, after 2 years, there's no score hits on a 2-year-old collection. All right? That's a big statement. Now, if it's less than 2 years old, I encourage you to either settle it. That's calling up the creditor, the collection agency, not a happy group. They're not friendly. And settle with them. See if they are willing to take less than what's owed to get a paid in full. And what you do is you basically, well, that's a whole different subject, but don't do that until you talk to me, because there are some specifics that I want to kind of coach you on before you do that. There's times to do it. At the end of the month is better than early in the month, and you've got to get a letter from the creditor or the collection agency in this case acknowledging that they're willing to accept that money for payment in full. And then the other option is you could settle it. I didn't mean sell it. You can work out a deal with them so that you pay them over time. Now, I don't love that, particularly with the collection agencies, because they tend to be a little on the rotten side. But if it's less than 2 years old, you ought to do something to figure out how to get that thing paid. If you don't have any money to settle or to work out a payment plan, then guess what? You just can't do anything. But if it's 2 years old, then you don't have to. So that kind of tells us that there's a timing type thing that we work on, so that we're kind of in that journey. And it may be that it may be a year old and you have to wait another year so it doesn't affect your credit, whatever that is. But each case is going to be a little different. Now, we'll move on to charge-offs. A charge-off is a status that means that the lender has given up. I mean, it's no longer trying to collect. So a lot of time the collection companies, if it's sent to a collection company, they'll stay on it forever, and it stays on your credit for a long time too. I think 7.5 years. But a lot of times you see a designation of a charge-off. As a matter of fact, here on the screen, and I'll try to blow this up, but these accounts, of course, marked out so that you can't recognize who this is, but they're charged off. That's a status on the credit report. And a charge-off still has a negative effect on your credit, but from a mortgage standpoint, you don't really have to do anything. And the only reason that the lenders, particularly ones that lend to people that have less than perfect credit, is because they're worried about a collection company coming back and trying to collect that money. If it's charged off, that means that the company is pretty much resolved. However, if you have the money and the inclination and need points, and that's what we're talking about, getting points, asking for a settlement or a workout plan can have a very positive effect on your credit after the workout plan is paid in full, or after you settle with them. I mean, 20, 30, 40 points I've seen just from paying off a charge-off. And you know, if you're lucky, it's a small charge-off, or you settle for something that's within your means, and you get nice point things. So that's what I'm going to say about that. And we'll go on to judgments. What do you do with judgments? Well, judgments are a nasty collection practice. As a matter of fact, Texas protects consumers from some of the creditors that try to put judgments on there. And in fact, there's only a very limited group of creditors that can put a judgment on you in the state of Texas. And a lot of times they'll do it. One of the things that you can do, if it's not one of the group that can put a judgment on you, then you just challenge them with an attorney and say, according to Texas statutes, you can't put a judgment on me in the state. And I've seen that work. And attorney's letter a lot of times is a lot cheaper than hiring an attorney to work hourly work for you. The negative thing about judgments, though, is if they're on their credit report, that means that they're recorded at a local county. Could be a county in wherever you live. I can thinking right off the top of my head of a couple from Nebraska that had a judgment in Nebraska. And we had to go and make sure that the county court proved or showed that that judgment was paid off or settled at the court level. And it adds an extra layer of hassle to it, but we've done it a handful of times, or maybe 100 times, I don't know. But it is a showstopper for a loan. You can't get a loan with a judgment on there because the lenders just aren't willing to take that chance. These must be satisfied or paid or resolved. It's got to be clear. It's got to show that on the credit report. A lot of times we have to walk that through the system. These definitely affect your credit score. They're bad. You must have proof that the county has recorded the judgment as satisfied. So if you've got these on there, guess what? It makes the process longer, because a lot of times what you have to do is you have to settle, or you have to work out a payment plan. And again, you can get a loan if you're in a payment plan as long as you've got 3 months on the payment plan. So, and you can't take a lump sum that represents 3 months of the payment to fast forward that. You got to have 3 months of showing that you're making those payments. That's one of the things that the underwriters require. And there we go. Oh, skipped one. What do you do with disputes? So disputes are an interesting animal. Okay, so disputes on a credit bureau is a way for a consumer to challenge what is recorded on the report. And this happens a lot because the credit reporting is not very accurate. And it's a useful way to challenge incorrect reporting or inaccurate information on your credit report. And after disputing information, the credit reporting agency has 30 days to investigate if your dispute is valid or not. If they find that there's no substantiation of the disputed claim, the dispute language generally just stays on the report. They call back and say, you know what, we checked it out and you do owe that money. And you go, well, you do. So what has happened over the course of the last 5 or 6 years, disputes are unusual because what disputes do is they kind of cover, if you will, or they make the creditor's information invisible to the scoring algorithm. So there was a time when it was a great idea to dispute everything, and what happened is when you disputed something, your credit score would go up because it would take the impact of whatever negative reporting was done by a particular credit line, and it would take it away. And I mean, for years, we just disputed everything. It's a common credit restoration process. And of course, they've got to do that to get something knocked off your credit, and they would just wear them out, continue. You know, there's a lot of steps that credit restoration takes to get credit off, wear the creditors out in most cases. But what we found is, or the underwriters were awakened to the fact that when the dispute comes off, if you take a dispute off, which they require these days, then the effect of that negative reporting comes back into the credit score. So when you take a dispute off, particularly if it's not at least 2 years old, or not the dispute 2 year old, but if the credit line, the date of last activity is not at least 2 years old, then it can negatively affect your score. I mean, if you had an example is, let's see on this one here, I may have gone back. Let's see. Let me see. Okay, let's see. Charge-offs. No, I don't want to see that. Okay, this is the one I was looking for. So in this particular report, and I don't know if you can see this, but it shows here that the last late payment that they had was October of 2016. Okay, if there was a dispute on that one, and the score would go up because the dispute would mask this particular report from this creditor, and it would be a good thing. And while they're doing the investigation, you get the benefit of the positive report. Now they come back and they say, well, you know what, the dispute is not valid. The credit is owed, and so and we're going through underwriting and we say, okay, well, we have to have that dispute removed because we do. Then when we took that dispute off and the borrower goes to the creditor and say, look, I need to get that dispute off, I no longer dispute it, it would cause the score to go down dramatically because this is a fairly recent debt. Their late payment is within the last 5 months, 5 or 6 months. So if it's 2 years or older when the last time that was reported, and there's a thing on here, I don't know if you can read it. Right here, there's and again on the video or on here, it says DLA. DLA. Let me see if I can. No, I don't know what that's doing. Okay. Oh wait, here we go. Well, here. Okay, it does say DLA is date of last activity. There's a couple things here. Date opened 5/15. The next line underneath that, which in this particular case is blank, is date of last activity, and then the date reported. Well, these are critical, important dates because that tells you how old the last time it was reported. And if it was over 2 years ago, then I don't worry too much about taking a dispute off. If it was recently, like in this particular case where it's 6 months, if there was a dispute on that account, it would negatively affect the credit score when that dispute was removed. So that may be way more information than what you wanted, but I thought that was important. So really, that is kind of the culmination. How did we do on time? Well, not bad. 28 minutes, a lot of information. The point is that, well, here's what we covered. How you got where you are, one of the two different, it's actually one of 3 different paths that you're on. If you have recent lates, you're not quite ready yet. You may need some time to get stabilized. And if you have no late pays since a year, you don't have any late payments on your credit report for the last year, then you're probably ready. It'd be a good time to call me. Dealing with collections, the same thing that I'm going to tell you when I talk to you and look at your credit, I'm going to tell what I just told you here. Charge-off, judgments, disputes, the same thing. And but I would very much like for you to call me so we can look at your credit specifically. And obviously, you've got my phone down there. We want to take your credit from what it might be perceived now as poor to excellent, and it's doable. And finally, this is Mike Durr, the Kingwood Mortgage Guy. Love to work with people, helping them improve their credit. And guess what? I know what it's like because I've been there. I'm not bragging about it, but we had some tough times in 2008 when the credit arena was exploding. But we stuck with it, and we're coming out on the right side of this. And I'd like you to also. So call me. You can reach me at Homebuyer Webby. You can call me, Kingwood Mortgage Guys, or you can email me. I'd love to hear from you. This is Mike Durr, the Kingwood Mortgage Guy, signing off. Have a good one.